Hi, Steve Van Metre here, and welcome to your Monday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that are crazy. I'm sure if you were watching the news over the weekend and you saw about the oil strike in Saudi Arabia, you, like me, were probably pretty interested in that. And I do want to talk about crude oil and yields tonight. Although what I had originally thought I was going to talk about going into the strikes in Saudi Arabia obviously have been shifted. We might have to carry some of those into Wednesday, which of course will have an update of the Federal Reserve's Federal Open Market Committee meeting, of which I still think, I'm going to go on record saying, I think we got a 0.25% rate cut coming. Now, before we get into my thoughts on oil, not from a political or any of that, I want to talk about from an investment standpoint, because those of you that know I'm very interested in this, but I don't think it's quite even time. And I don't think this move that happened today is going to stick. I want to tell you why. And then let's talk about why interest rates backed up ahead of the Fed meeting. The content of this video is provided as educational information only and is not intended to provide investment or other advice. This shows not to be construed as recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre Financial. Business expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Okay, so what happened? I shouldn't say what happened. Why did oil shoot straight up? Was it because there was a strike on the Saudi Arabian oil fields? Sure. Does that dictate such a big move in oil? No. So what happens, and you see this primarily in U.S. markets where there's a lot of speculation. It's kind of interesting. The U.S. markets are more like Las Vegas than they are, a safe place to invest. There's bettors on both sides, speculators on both sides, and people that are leveraged on both sides. So what happened is people that were short crude oil going into this weekend, and there's a lot of good reasons to be short crude oil. When the global economy slows, guess what? Demand for crude oil slows. And the other issue is there's a lot of supply. And this is something you've heard me say, there's a lot of supply, a lot of supply. And I know some people say, well, can you quantify it? No, but I can. Now, I've got some really great stuff on that. So when you're short, a lot of people that are traders, speculators will put stop loss positions and say, okay, I'm short, so I'm betting oil goes down, but if it goes past this price here, automatically sell. And when you get a lot of people that are sitting on stop losses like that and price goes through it, ding, 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 ding. It's like a slot machine. Ding, 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 boom. And all those people that are short, by just unwinding their short position, become buyers and shoots price up. So what do I think's likely going to happen? You guessed it. I think that those short sellers are going to come back in at this higher price and drive oil back down. Now you might say, well, isn't that going to hurt? That's cut 5% of the global production. All right, let me tell you what finally I was able to find. I got to read this because I want to make sure I'm quoting it correctly. According to Christian Malik, head of oil and gas research for Europe, Middle East, and Africa at JP Morgan. So this dude's obviously the expert in oil. He said, quote, we are massively oversupplied, quote, in crude oil. Malik went on to say that it would take 5 months of a 5 million barrel per day outage, which is exactly what we're facing right now, potentially as a 5 million per day barrel outage. Although according to Saudi Arabia, they're going to bring quite a bit of that back online very quickly. And because apparently some of it was shut off just as automatically shut off, just needs to be turned back on. So he goes, it would take 5 months of a 5 million barrel per day outage to take global supply levels, are you ready for this? Back to its 40-year normal average. 5 months of a 5 million per barrel day, which is 5% of the world's production, to get down to the 40-year average. Does that tell you how oversupplied we are? This doesn't even make a dent. And that was the information I have not had, but I knew the number was big. And that's assuming over the next 5 months, demand doesn't change. That's assuming demand is constant. Then we get down to the 40-year average. That still says we got a lot of oil. So you see, a lot of this was overdone. And this, what the market will use the term pump and dump, where people will pump it up and then they'll kind of come back in and sell it back down. And it should not make a huge difference for U.S. oil inventories because Saudi Arabia has already dramatically cut their exports to the United States, so we can try to draw down our inventory because guess who's the number one oil exporter in the world? We are. That's right. So we've got the ability to pump a ton of oil. But the market is massively oversupplied. And so, yes, is there oil available? Could Russia pump more? Sure. Can other countries pump more? Sure. President Trump said he would authorize oil coming out of the Strategic Petroleum Reserve. But now when you know that we have a 5-month oversupply based on a 5% daily reduction in production, we don't have a supply problem. We have a demand problem. And this is where it comes back to, things that kind of really irritate me about the Federal Reserve. Because when you get these really long, economic expansion, I always do it backwards, right? I remember it's a mirror for you. These really long economic expansions, what happens when you have subsidized low interest rates by central banks and money printing schemes by central banks, is you get overproduction. And one of the things I've said, and I'll say it again, is the next recession is going to be a lot worse than any one we have seen in our lifetimes. And it's really simple. Let me give you a really good example. Let's say I'm an auto manufacturer. Because I got factories just pumping out cars, but as it turns out, I have a 5% oversupply in the market. Not per day, but just a general 5% oversupply. Now, what can I do? Maybe I cut some of my shifts back a little bit, cancel some overtime, do some specials, some factory incentives, maybe some subsidized interest rates a little bit, and I get that inventory cleared out. And then once I understand where the real balance is of where supply and demand is, I bring my production down to match that level and I'm fine. What happens if I'm oversupplied in the market? By 100%. Maybe I've got so many cars that I can't even unload them even at a discount. Who's got a problem? I'm out of business. That's what happens in these long expansions, and why we get in these, and the Fed will say, well, we'll do everything we can to continue the expansion. They have no choice. There's so much oversupply, and oil is just one indicator. Mind you, I've been digging for this information. I have friends and clients that work in the oil industry, and they know too. That I hear from their sphere of influence. Say, look, Steve, I can tell you we're oversupplied here, but I don't know how much. But I just know we're oversupplied. Well, you start taking these views from multiple people at multiple companies in multiple geographic areas around the world, and you say, well, clearly we're oversupplied, but by how much? 1%, 10%? 5 months at a 5% reduction. What's going to happen when we all find out how oversupplied all the rest of the other economy is in cell phones and cars and all this other stuff? That's why companies are going to go out of business, is because they won't be able to move product because they can't move it now. We have to keep lower interest rates. We have to keep central bank money printing to try to drive demand, which is drying up because we oversupplied. And one of the key things about recessions is, and you go back and look historically, back before we had central banks, you'd see expansions were like 2 years long-ish, and then have a 6-month dip. Most people wouldn't even know. Unless you worked in that industry or knew someone did, you wouldn't even know. But when you have this 10-year, is that right? Yeah, 10-year long expansion, and you just get a glimpse from the oil industry, how oversupplied they are, what does that tell you when people start figuring out how much oil we do have and how long it will take to chew it up during the next recession? What is that going to mean for jobs in the oil sector? They're going to go away. And what's going to happen when those jobs go away? Where's all that money that flows in the economy created by all those workers? It's going to go away, and it's not going to come back right away. Because in recessions, demand falls. So, well, that's okay. My company's profitable at $30 a barrel. Well, at current demand. What if at $30 a barrel of oil, demand's a half? That's the problem here. But people are like, oh no, everything's great. Until you hear this data today, you didn't know. I had an idea, I didn't know. So the notion that the news reporting that oil is going to go to $100 a barrel when you have this kind of massive oversupply, it's called pump and dump. Oil's going to go to $100 a barrel? I'll buy. Now, would you go buy it if you knew there was a 5-month oversupply based on a 5% daily reduction? No, you wouldn't. And then you kind of look at the hedge funds and you go over here and thanks to Hedgeopia, you go and look at all these hedge funds that are propping oil prices up. This is why we look at this hedge fund data every week. They're propping oil price up. Can you imagine if these hedge fund speculators backed off their long positions, how low oil is going to be? It's going to be cheap for a long time, a couple of years, which would be a great opportunity at the time, whenever that is, to buy oil or oil and gas company stocks or whatever it is, but not now. Interest rates. So why did interest rates back up? We may not even get to what I want. We'll go over. I don't care. I think this is really important. You have to really think about what's going on in the economy. And when you get this news, you can't dismiss it. And I've been looking. I've been digging deep. And thank you to Christian Malik at JP Morgan for posting that, or whoever copied it. Thank you to them. Now let's talk about why interest rates have backed up. And it's kind of bothered me a little bit. You can hear people say, well, technically, bond market went up too much and blah, blah. Okay, yeah, forget all of that. Let's talk about the Federal Reserve meeting. Interest rates lead the Fed. This is very important. The bond market tells the Fed what to do. The Fed does, look, everyone says the Fed's independent, the Fed, we're independent. No, you're not. You do what the market tells you to do because you don't know what the market sees. The Fed uses old lag data. That's why they turn and look to the market. So what do we know going into the meeting that starts tomorrow there's going to be a press release Wednesday. Whether there'll be a change in interest rates or not is to be determined, but the probability is very high because the federal funds futures is saying there's 100% chance of a 0.25% cut in the federal funds rate. And the Fed will look at that and be like, man, markets clearly think that we need to cut rates by 0.25%. Maybe they see something we don't see, so we better cut. Okay, so they'll cut. But what did the markets really want? 0.5%, 0.75%, full percent. How do we know that? Because interest rates went boop. And the Fed said, federal funds futures said, no, we're up here. So what happens? Interest rates go back up because they have to give the Fed a nice, comfortable feeling about their decision to cut rates. And here's what's interesting. If you cut the federal funds rate by 0.25%, then the federal funds rate is going to be around 1.85 or 88%, somewhere like that, because they're doing this blended rate, this 1 point, it'll drop from 2 to 2.25 to 1.75 to 2. So yeah, I think it's like 1.88%. Well, guess where the 10-year Treasury is sitting? Right about that. Isn't that coincidental? That the market would allow 10-year Treasury yields to rise up just to barely either to slightly uninvert them or to leave them slightly inverted where the Fed won't worry. Isn't that interesting? I think so. That's why the market backed up. So my guess is, and why we haven't rebalanced the portfolios, we're letting the market kind of work this self out. But by the end of the year, the Fed's probably going to be at zero. Because remember I told you there's going to be this $300 to $350 billion of debt issuance? That number's now grown to about $600 billion over the next 4 months. So the U.S. Treasury is going to offload $600 billion worth of debt into the U.S. economy. And due to increased banking regulations, things called like Basel III and whatnot, the banks don't have the outlet like they did. This money is going to come out of the broad economy. It's going to be a massive liquidity drain. Not only are we going to have $600 billion pulled out, but I should have pulled this up, but if we go back to the monetary lags from 18 months ago, we just hit the first month of $30 billion in quantitative tightening. We got a long ways to go. So we have next month would be 18 months ago, 30 billion quantitative tightening, another 30 billion, not counting the rate hike. So you're talking, looking backwards, like 2.5 rate hikes in a 3-month period. And then the fourth quarter, you have roughly another 2.5% rate hikes based on the quantitative tightening, plus $600 billion which is equivalent to 10 rate hikes or 2.5% increase in the federal funds rate. Why are interest rates going down so much? Why is the Fed likely to be at zero in quantitative easing by the end of the year? Because this is really where understanding monetary policy teaches you as an investor how things really work. And you have to look back. We've talked about it. Maybe if the more I talk about it, more it'll make sense to you. What did the Fed do when they did quantitative easing? They bought bonds, right? They bought bonds, and what happened? Short-term interest rates went down. Long-term interest rates went up because they were putting liquidity into the economy. Now, what's going to happen when the U.S. Treasury goes out and does the largest, not almost largest, not the second largest, the largest liquidity drain in history in a 4-month period? Well, short-term interest rates should rise. They may not, because there may be demand for it because people may funnel into short-term rates and the Fed's probably going to be forced to ease. Long-term rates go down because when you pull liquidity out of an economy and there's less money floating around, guess what? People can't go and buy homes. They can't get the loan. They're going to struggle with that. So long-term interest rates fall. It's the opposite effect. That's what's really cool about all of this. That's what's going to happen by the end of the year. And that is why I believe interest rates went up, was to give the Fed a warm and fuzzy about their 0.25% cut they're going to have to do on Wednesday. And then the market is going to set up for a much bigger move lower because the Treasury is going to start borrowing and force the Fed back to zero. It's going to be spectacular. Let's take a look at the hedge fund positioning. 10-year treasuries, which is odd. The hedge funds backed off their shorts and interest rates rose. Once again, they found themselves on the wrong side of the fence, but my guess is they will be back shorting this. Same with 30-year. They backed off a bit and interest rates rose. Again, this is all because of positioning. So oil is already long. There's already a lot of long investors in oil. So I don't know this. I don't see how this thing can get to $100 a barrel, especially with demand weakening. Looking at S&P 500, they went net short. Kind of makes sense. I would agree with that. Gold still very much near record or at record long positions, starting to roll over. People say gold goes up from here. Look, what happens when markets go down, people that are short treasuries, which these speculators are and retail investors are, they're short. Maybe they're not directly short, but they're short because they don't own them. Long stocks and short volatility, guess what? When you got to start covering your shorts because you're getting whacked when stock prices go down to liquidity drain, you got to sell something. That's why they sell gold. It's why you have the largest commercial short position or second largest in history on the commercials in gold. NASDAQ, they're long on tech stocks, probably because Apple buys so much of their stock back, have to be the case. Note on Apple, I know everyone thinks that iPhones sell like crazy. The preliminary orders for the new iPhone are somewhere around 10 to 20% less than they were for the last iPhone. So demand isn't there. They backed off their small cap shorts. Dollar, they're maintaining their same positioning. But look at volatility. They went shorter volatility, and this thing is expected to spring like crazy. And we've looked at that, and we'll probably look at that again in the future. So let's just quick scan of some charts for fun. S&P 500 sitting near all-time highs. Taking a look at volatility, which you will never trade, crawl back up right over support at market close. So this is telling us that volatility is looking to spring here. See, rising oil prices is not, you might say, well, I thought rising oil prices is good. Look, it's good in the right time. It's bad when financial conditions are tight because that means higher consumer prices. Higher pump prices means less money for discretionary spending, less money for restaurant spending. There's a lot of support or resistance right in here. And you can see this big volume. There's your short squeeze, yanking all of these people out. My guess is this thing doesn't last a whole lot longer. Taking a look at the bond market, 10-year treasuries held resistance right in here. Right below where the federal funds rate should hit Wednesday afternoon, and the 30-year back down too. So this thing just may sit where it is. Maybe it goes up a little bit. Chances are I expect us to turn a little sideways. We'll want to get in here at some point, let the sellers exhaust themselves, because once that liquidity drain comes, the party for them is over. And take a look at ags, a lot of nice volume here. What do we get? Some news, there's some more export orders. Plus, today we also found out that perhaps yields are still not as good as anyone thought. And boom, you see some nice volume, a nice rise in price. And we will have to wrap this up at 20 minutes. So anyways, I'm Steve Van Metre. Thanks for taking the time to watch. And we'll see you Wednesday with the FOMC decision. I'm sure it won't disappoint the market at all. Bye now.